All right, so now we got to talk about the second inventory decision that we have to make. So the first decision we make is, how do we count our inventory, right? How do we come up with our cost of goods sold? How do we come up with our ending inventory? The next one we got to talk about is how do we price our inventory, right? So when we're recording it, how do we price it? And there are two different ways that we're going to do that. We're going to either price it at the gross or the net price method. Okay, so let's say that you have a piece of inventory and that cost of the inventory is $10,000 for the purchase price, and then you got to pay shipping of $300 and insurance during the shipping process is another $200. That brings your total cost of inventory for that piece of inventory to $10,500. Okay, but remember that some vendors offer discounts to you. Okay, just depending on what the situation is. Maybe you're buying in bulk. Maybe you just got a good relationship with that vendor. Whatever the case, right? They may offer you a discount. That discount we put in terms of 210 net 30 or 410 net 30, whatever the case is. And it basically, if we recall, just means 2% discount on the purchase price if you pay it in 10 days. If you don't pay it in 10 days, then we expect the full amount in 30 days, the net amount in 30 days, right? So once you have information on that discount, if they're going to offer you a discount, this is where the decision about gross or net comes into play, okay? If we decide to record the cost of our inventory at gross, we use the gross method. That simply means that we're going to record the inventory as though no discount will be taken, right? So we would record this at the full $10,500, okay? That's as though no discount will be taken. However, if we do pay within the term date, the 10 days, then we do get to take the discount. We only record the discount if we actually take it. So at the end of that 10 days, we'll take that discount. We'll make an adjustment for the discount. The net method is just the opposite of that, right? We're recording the cost of this inventory. We're recording the cost of the purchase as though we are going to definitely take the discount. So in this case, instead of recording it at $10,500, we would record it in our books, the purchase or the inventory increase, as $10,290, 98% of the $10,500. Now, we will talk about later what happens if we don't get that discount, right? If we decide that we're not going to pay in those 10 days. Okay, we'll talk about that later. So let's take a look at some examples here. Let's look at a perpetual inventory method and recall that the perpetual inventory method, we hit our materials or we hit our inventory directly. We're going to directly increase that inventory. Okay, so let's assume that Apple purchases $21,500 worth of direct materials inventory. They're recording it using the perpetual inventory and the net price method. Okay, so the vendors offered them a 210 net 30 discount on the materials. This is how they would record that transaction. They were going to record the increase to inventory directly. They're only going to record 98% of the purchase price, right? They're recording this at the net method, which is assuming that they will take the discount. Okay, so they're going to record it at $21,070 instead of $21,500. So it's the purchase price, and in this case, it's not times the discount, but it's times 100 less the discount, right? We're just trying to get that total number. And then we're going to increase our accounts payable liability. The reason we're increasing accounts payable liability, recall, is because they purchased it on account. Okay. So again, I will point out right here, notice that the perpetual method is being used. We increase inventory directly. Okay. So the next example would be a return. So you've got discounts. This is a return, and everybody knows that the return is basically you are sending some amount of the inventory back. And here's where it can get a little tricky. This is why you have to keep good track of your discount. So let's assume that they're going to return $2,000 worth of the inventory due to defects. Okay, we need to reduce our accounts payable liability. Okay, but we also, because we no longer owe that money, but we also need to reduce the inventory asset because we no longer have that inventory available for us to sell. Okay. What we're going to do here, though, is because what we're sending back is not actually worth $2,000. It's actually worth 2% less than that $2,000 because that's what we actually recorded it as. So we would take the $2,000 worth of inventory that we're returning, multiply it times that 0.98, and that's where we get the $1,960. So this is a decrease to accounts payable and a decrease to direct materials inventory. This is a mistake on my part. This should be adjusted to the left because this is a debit. You can see that with the dollar amounts here. Okay. So next we'll talk about net method using a periodic inventory system. Okay, we just talked about perpetual, meaning it's continuously checking our purchases, it's continually checking our sales. With the periodic method, we're not doing that, but we are going to be able to more closely track our returns, allowances, and discounts. But we use those temporary accounts like purchase accounts, right? And we use the purchase returns and allowances temporary accounts. So let's assume that the glue that we purchased in the earlier example, we recorded that at the net price method. Remember, we purchased it for $500 in the previous example. Okay. Let's say that they offered us a $210 net 30 discount on the glue purchase. We would record it this way. So purchases, instead of being $500, would be $490. 98% of that $500 purchase price. Remember, we get to take this at the minimum purchase price. And that minimum purchase price is the full price less the discount. Okay? So we're recording the $490. Again, we bought it on account, so we're going to increase that accounts payable for $490. Remember that purchases account, that is a temporary account. We're going to close that account at the end of the period. That's why there is an adjustment here. This is why with the periodic system we make that adjustment. Okay, so as opposed to recording it directly to the inventory like we do with the perpetual method, we're going to record it only to the purchases account in the periodic method. Okay. Now let's assume that that same 20% allowance is offered as in the earlier example. So recall some of the glue that we ordered was not the glue that was sent to us. They were out of stock of what we actually ordered, so they offered us a 20% allowance, right? And we took that 500 times 20%, that gave us $100, and that was our allowance, okay? Again, just like the perpetual method here, though, we have to remember that since we have recorded this at a discount, that purchase was only worth $490, okay? So really what we're doing at the end of the day is we're taking the $500 and we're multiplying it times that 20% allowance, and we're going to multiply that times the 98%, which is the purchase price less the discount, right? So that gets us the $98. So this is where you've got to be careful, because this is where you can get thrown off pretty easily. You've got to remember that if you take a discount on something and you make a return or you get an allowance, okay, you have to record any returns and allowances at the discounted rate. Okay, so just remember that. That's where you can get thrown off. Okay. So let's talk about what happens if we pay within the discount period. Okay. So if we're using the net method, we're going to assume that they paid for the materials inventory within the discount period. Okay. This means that they're entitled to pay only the minimum amount due, that $19,110. Okay. So remember, we had the discount, we recorded it the net method, so we recorded the entire discount, that $21,070. Okay. Now we're going to remove the $1,960. Recall that was the return, right, that we made. Okay. Right here in this transaction. Okay. So we're going to take the accounts payable that's owed, that's the amount, the full purchase price times the discount, less the return. That leaves us with an accounts payable that we actually owe them of $19,110. So we're going to decrease our accounts payable because we're actually paying it right now. And then we're going to decrease our cash, because how did we pay the accounts payable off? Well, we paid it with cash, right? Finally, we're going to look at the gross method. Okay, this is where we recorded the purchase of inventory as though we did not take the discount. But what's happened is we actually did take the discount. We ended up paying within that 10 days, so we're still entitled to pay only that $19,110. Okay, so what we're going to do is we're going to take that, take our accounts payable, reduce it by the amount of the return, the $2,000. That gives us $19,500 that we're trying to clear out. Okay, so that's our debit. Now we know that our credit has to equal that. So what are we paying? Well, what we're actually paying is only the minimum due amount, and that's the $19,110. Okay. Where does the rest of this come out of? Well, we've got to reduce the value of that inventory by 2%. So we take the $19,500, we multiply it times 2%. That gives us the $390 value of inventory. So we'll stop there. We'll have one more video, I believe. But if you have any questions about this, please feel free to